Well, last time we spoke, we weren't particularly optimistic about the market, and then of course we saw some decent performance in the intervening period, but most of that has been lost in the last week. The reasons why I was tentative last time was that the key driver of these markets remains that US economy and that US share market in particular, and the prospects are still not very good there. The market was anticipating that the Federal Reserve would provide a major stimulus to liquidity by buying outright securities, and we heard talk of anything from government bonds to Fannie Mae, Freddie Mac to something even more imaginative than that, such as corporate paper. It's not happening. All the Fed has said is that it will roll over the cash that it gets from maturing paper into other government bonds rather than anything more imaginative. So the market was fairly disappointed with that, and we've seen a correction to follow. It's also true that the prospects for growth in the US have deteriorated in the eyes of the market in the last few months, and I think, as we've been warning for the last year or so, that doesn't surprise me at all. The reason is that what we were seeing even a year ago was that the people talking V-shaped recovery were very much focusing on lead indicators that were pointing in vertically upward, but that was reflecting a huge restoration of inventories and a huge fiscal stimulus that the US economy went through last year. That was about to end, and what we were looking for was any evidence that there was some sustainable growth coming from the private sector. That's businesses investing, consumers spending, and jobs being created, and the evidence of that was fairly limited. And as a result, now that those stimuluses have faded away, there's not a lot left there to give the US economy the next upward stage that you normally expect when you have a big fiscal stimulus, you have a big turn in the inventory cycle, and the fire gets lit for the private sector, and away we go. And that's how we've seen previous recoveries operating. Not happening like that this time. Obviously, one of the key factors has been the excessive deleveraging that still has to happen, has been the associated overhang of housing, and has been the general lack of confidence that businesses have. Businesses have 1.2 trillion in cash sitting on their balance sheets. They're not prepared to put it to work because they're not convinced about their sales prospects. The rise in the US dollar against the euro was also rather unwelcome. And of course, when we read the surveys, the other factor that's worrying business a lot is regulation. If we look at the Australian market, the valuations look to be about fair value, nothing what I would call particularly cheap, and not what I would call particularly expensive. The prospects, of course, as usual, will be dominated by the outlook for the financial sector and the resources sector. Now, the resources tax Mark II, of course, has been welcome for that sector, but the critical thing there will be the profile for China over the next 3 to 6 months. I was in China a couple of weeks ago, and I was certainly impressed with the confidence that the people in China have with regard to the government's ability to turn around this slowdown that we're seeing at the moment. And it is a slowdown. The reports that we've seen of piles of mounds of iron ore with the steel companies cutting back on their production. One point there we saw the spot iron ore price collapse from $90 to around $117. It's now back in the high 130s, mainly because it ran into the price that the local producers can produce at, which is around about 120. So if the price falls below that 120, then the local producers withdraw from the market, supply tightens, and prices tend to rebound. But evidence of a sustainable turnaround in that construction cycle in China is pretty hard to find. So I remain quite nervous about the prospect for commodity prices in the near term. Within over the next 6 months or so, I expect to see a lot of new policies being announced for China that would give us a lot more confidence that that construction cycle is being restored, and I expect to see easing up on the restrictions that the banks have been put under recently. If we don't see that, then the prospects for commodity prices in the near term do not look good at all. The market has not reacted well to the recent results from the Commonwealth Bank, pointing out the fact that their margins have narrowed, and we can't deny the fact that the funding issues that the banks are facing as a result of their high reliance upon offshore funds, which directly reflects Australia's world-class current account deficit. We can't deny that that's going to remain a major issue for the banks going forward. In terms of the underlying economy for Australia, however, I'm relatively optimistic. I'm not looking for a sort of a big rebound in the economy. I am looking for a rebalancing away from government spending towards business investment, the household sector, and in particular residential housing investment. But the peak in growth, I think, is going to be the second half of this year, and next year I think things will start to slow down somewhat as the Reserve Bank raises interest rates, as housing markets become somewhat over expensive, and as we start to see the continuation of a fairly conservative consumer. So while I'd like to be more optimistic about the markets in the near term, I have to say that the boxes that I'm ticking, being the outlook for the US and the US share market, the outlook for China quickly turning around this slowing period that we're seeing at the moment, and in particular the outlook for the funding issues being faced by the banks, none of those three give me a lot of confidence. So I'd have to say that at this stage anyway, I'm remaining fairly cautious about the outlook for the domestic share market.